Hello and welcome to the first lesson of our third session for CME products in CME Institute Spring 2020. In this two-part session, we're going to begin our investigation of equity index futures, beginning with the foundational principles. And then in the day two curriculum, we'll dive a little more deeply into practical applications using equity index futures. But let's start at the beginning. Everything to do with index futures references back to a couple of very important principles. One is indexing, the indexing of individual listed shares of companies into a stock index. We're going to look at global stock indexes in just a minute. The second is this concept of benchmarking. And benchmarking is the means by which most asset managers or mutual funds are rated and evaluated, both against their competitors, but also different managers against different benchmarks. In other words, funds receive incoming deposits and additions to their asset base when they perform well versus their benchmarks. Funds lose assets and see capital drain from their funds when their managers and performance risk managers underperform benchmarking. So benchmarking is an important concept in the world of indexing and stock indexing. There are a huge amount of global equity index benchmarks in every region, in every part of the planet. If you look at Europe, for example, in the United Kingdom, the FTSE 100 is the domestic benchmark on equity indexes. In France, it's the CAC 40. The DAX is the index in Germany. In Asia, you've got several in Japan, the TOPEX, the Nikkei 225, the Hang Seng in Hong Kong. And in Latin America, you've got the IPC in Mexico and the Ibovespa in Brazil. Most of these recognized benchmark indexes have listed derivative futures or equity index futures based on them. In fact, if you look at the NASDAQ 225, it has listed equity index futures on three separate exchanges: the Osaka Stock Exchange in Japan, the Singapore Exchange in Singapore, and CME actually has two futures contracts based on the Nikkei 225. One is a US dollar denominated contract, the other is a Japanese yen denominated contract. According to the World Federation of Exchanges, equity index futures are the largest listed futures contract in the world. Compared to all other futures contracts, equity index futures trading volume is by far and away the largest. And if you look at the audience, you'll notice it is global. Asia, Europe, emerging economies, Latin America, all have representative futures contracts that trade in this space. CME, because of the equitization and size of the equity market in the United States, is the largest, and we have the largest trading volume of all listed exchanges in this product class. Presently, CME lists 59 equity-based futures contracts, equity index-based futures products. Of those, we've got options on 29 of them. Not all of them are as liquid as others, but it's worth investigating because options, as noted in a previous presentation, is probably the fastest growing part of not just CME's business, but also global listed derivative trading. You'll notice that in our flagship benchmark products, we have futures contracts based on the S&P 500, the NASDAQ 100, the granddaddy of them all, the Dow Jones Industrial Average, as well as foreign futures indexes like the Nikkei as mentioned, but also specialized indexes like the Midcap 400, the Russell 2000, and even futures contracts based on the 11 sectors of the subsectors of the S&P 500. There are 11 sector futures, as there are 11 subsectors of the S&P 500. In addition to these flagship products, we've also launched some what might be referred to as more specialized products, including non-dollar denominated ones, contracts based on the China 50 index, for example. The FTSE 100 is denominated in sterling. We have futures contracts based on dividend futures, both quarterly and annualized contracts, even futures contracts based on ESG indexes and total return indexes on the S&P 500. Why is the S&P index the one that I refer to most often? It's the one we're going to be using as our for most of our examples in these presentations. Well, it's because it's the most tracked and the most followed by the institutional community. The Dow Jones Industrial Average is by far and away the oldest average or index, but the S&P 500, which was established in 1957 and was the first capitalization weighted index in the United States, has really become the institutional benchmark for equity index performance. There's almost $10 trillion worth of assets benchmarked to the S&P 500. It takes in roughly 80% of the total U.S. stock market capitalization. So when professional risk managers talk about the U.S. equity market, they refer to it in terms of the S&P 500. The S&P 500 is a broad-based multi-industry index. The top 10 holdings represent roughly 25% of the total index's constituent value. It is huge and takes into account a large magnitude of different industries, very diversified index. As you can see, the 11 sectors of the S&P 500 are listed here, and then the breakdown within the pie chart here, according to a recent description by the S&P Dow Jones Indexing Business, shows you that the S&P 500 is a well-diversified index based on U.S. corporate stock issuance. CME lists 3 futures contracts based on the S&P 500. The original floor-traded contract is referred to as the BIG, and we call it the BIG because its multiplier is very, very large. It's a $250 multiplier, which means at the index equivalent value, its notional equivalent is, I think, roughly around $400,000 at the moment. The E-mini contract that is traded exclusively on Globex is a little bit smaller and has a $50 multiplier, an index value of somewhere between $130,000 maybe and $140,000 per contract. And then a recently launched Micro E-mini, which has even yet a smaller multiplier, and this was designed to appeal to ETF investors and retail self-directed traders. Its index value is going to be somewhere around $13,000 to $14,000 in notional equivalent, all tracking the same index but having different sizes in terms of their notional value. And this is our effort to appeal to a wide audience of equity index users, from the very large institutionals that use the big contract to the E-mini, which is popular among both professional as well as self-directed investors, and then the micro, which is designed specifically to appeal to a smaller trading environment for smaller account size. Daily settlement in the S&P 500 is arrived at a mathematical formula that takes into account the final 30 seconds of trading at 3:14.5 to 3:15 Chicago time, and does a volume-weighted price of the E-mini as well as the big contract. This is important because they both contribute to daily trading activity, and it's important to get the price action from both contracts. The micro E-minis aren't included in the daily settlement value, but they'll settle to the value established by this formula. So that it would be, if once you begin to investigate these contracts, you'll notice the E-minis trade in quarter index points. The big contract trades in 1/10, or what we call dimes, of an index point. You may see a daily settlement value even if you're trading E-micros, micro E-minis, or E-mini S&Ps that doesn't settle to a quarter index point, and that's because of this volume-weighted average settlement price based on the big contract and the E-mini. The final settlement value for all contracts in the S&P at expiration, and this goes for all of our index products, they settle to what is known as the special opening quotation. And this is, of course, shortened to an abbreviation called the SOQ. The SOQ is calculated by the index provider itself, and it's done on a daily basis, incidentally, but on the final day of trading, it's used for the final valuation of the futures contract. The special opening quotation, as calculated in this case, let's say by the S&P 500 company, takes into account the actual opening traded prices of all the constituent members of that index. So for the S&P 500, which has roughly 505 constituent members, the Standard & Poor company takes the actual opening traded price of all 505 constituent companies, runs it through its index calculator for the day, and spits out a number known as the special opening quotation number. That number is the final settlement value of that expiring futures contract. So, for example, on March 15th, which was the final day of trading for the March 2019 futures contract, the SOQ was calculated to an index valuation of 2811.89 points. That became the final settlement price for that futures contract. And as this is a cash-settled futures contract, the previous day's settlement value versus this final settlement value determined what the losers paid the winners in a book entry system through CME Clearing. Then the March contract expired, and a new quarterly contract was listed further out in the listing cycle, and business went on as usual. Trading in the index products has spiked recently because of market volatility and a magnificent sell-off from what were recent all-time highs in the S&P and most broad market indices in the U.S. But more importantly, this chart shows you a couple of important features. The trading volume in this year has increased, would probably appear somewhere up in here, because we've had such a spike in trading volume. But what I want to point out in addition to that is if you look at these little blue tips at the beginning, they look like little match heads at the top of a match. Back in 2008, that represents the options as a portion of our average daily trading volume. And you can see as you move from left to right on this chart, the percentage or the increase in options trading is significant. This is accounting for the increase in options trading, not just in equity index products, but across all of CME's products, in fact, across all exchange-traded products around the world. We're listing more options expirations, more short-dated expirations in all of our products, and it's based on industry demand, which is helping to drive the volume in options as well as futures higher. Liquidity is probably the single biggest concern of any risk manager or market practitioner, and nothing speaks to that more poignantly than what we've been living through the last 4 weeks in terms of market volatility and price action. Having access to liquid products is the lifeblood of any successful trading venture or managing the risk of any large equity portfolio. If you consider the notional equivalent value of just the E-mini futures contract, here represented in this column with ES, which is the trading symbol for the E-mini S&P 500 contract, and compare it on an average daily basis to all of the transactions on all U.S. stock exchanges, you'll see the E-minis out-trade in notional terms all of the activity on all cash markets in the U.S. If you compare the E-minis in notional terms to the total volume traded on all of the ETFs representing indexes to the S&P 500, it's not even a fair fight. It's usually 9 to 10 times the volume is traded in E-mini S&Ps compared to all of the ETFs that are tracking the S&P 500. So when risk managers are looking for liquidity in an index product, the E-mini S&P is by far and away the most liquid product available. The other thing to note is that because this is traded on Globex, it's available 23 hours every trading day. So it's available even during the Chicago night session. So when you need, as a risk manager, particularly an international risk manager, if you're tracking the S&P 500 or the U.S. equity market, This product is liquid and available 24 hours a day. And it is one of the products on Globex that has an enormous amount of liquidity in non-U.S. trading hours. So who uses this product and why? Well, our federal regulator, the CFTC, requires us to produce for them who holds the open interest in our products. And in financial products, they ask us to break it into reporting categories. They're not interested in the actual names themselves, but what type of business those accounts are in. In financials, they ask us to break it into one of four categories. Dealer intermediaries, which represent banks, broker-dealers, people that act usually on behalf of someone else. We would call these sell-side firms in the U.S. The second category, asset managers, institutionals, these are going to be what we call buy-side firms in the U.S. Asset managers, pension portfolios, insurance portfolios, things of that nature. Leverage funds are who you think they are. This is going to be the hedge fund community, the CTAs, commodity pool operators, anybody who's operating from a speculative standpoint and may be employing leverage in their trading activities. And then the fourth is just large reportable firms that don't fall into one of those first three buckets. If you look at that activity in the open interest, and this is a sample from not too long ago, but it's representative of the activity in general cases, you'll notice the dealer intermediaries are involved to some degree. They tend to be the dark blue line here showing you shorts, the white line showing you longs, and then the lighter blue line showing you spread positions. They tend to be more short than long because they tend to be the group of traders that produce other structured product based on the index. So they create products that they sell, and then they're therefore short those products. They need to lay off that risk in the futures market. You'll notice that by far and away the largest participant here is the asset manager institutional community, and they tend to be predominantly users from the long side. We're going to be exploring why this is the case a little bit further in this program in part 2, but even to a greater extent as we dive into the more practical applications in the second day sessions on equity index products. So stay with us for this. That concludes part 1 of our equity index foundational principles. Come back for part 2 of foundational principles when we get into a little bit more about the pricing mechanics, the cost of carry, and the basis in the equity index products. And then we'll finish part 2 with a very simple example of beta replication, summarizing the capital asset pricing model that introduces concepts like beta and alpha into the vocabulary. So do come back for part 2. If you have any questions about what we've covered in this